Maruti Suzuki, we anticipated that it would be a tough day of trade for the company, but that hasn't come through, especially in the light of the kind of cuts that you've seen in the target prices for some very prominent brokers. They've actually cut the target price quite significantly. So it's surprising the way that Maruti Suzuki is reacting in trade today. Let's talk about that in more detail. Puneet is joining in to talk about this. Puneet, the numbers came through during market hours and there was that surprise miss on the PAT number that was on account of that exceptional increase in tax outgo. Operationally, though, there was not too much to worry about really, but the commentary seemingly was a little muted. What did you make of it, and what are the brokers saying?
Well, definitely, so we saw the numbers when, as you rightly said, it came during market hours and the margins were a little lower. And when we spoke, we had the management on NDTV Profit as well, and in the analyst call as well, that this higher discounting is what prevailed in this particular festive season. So that's one of the key reasons that the margins were down. But the company said one particular thing which might have enthused the street, which is that they've seen 14% sales growth in this festive season. So it's from the beginning of Shraddh until Diwali, which is tomorrow, but until yesterday is when the result came out, they said they've seen 14% growth compared to the same time last year. And I think that's the commentary, that's something like the street is taking positive note on. But as you rightly said, brokerages have come out and they've downgraded the stock, and we selected a few reports that talk about the same and what are the key concerns according to them. The first one, Citi, they have maintained their buy with a target price of 13,700 rupees, but it's down from their earlier target price of roughly 16,300, and that's reflective of the numbers in this particular quarter. It's still an upside of 24% from the previous close, so around 20% growth, 20% upside from the current levels as well. And they mentioned that the results were weaker because of higher discounts, and that's led to the gross margin declining. They've cut their EV to EBIT multiple to 23 times versus 26 earlier, but they say that the stock is trading at a 35% discount to its 5-year average, and that might be one of the key things. The valuations are quite different as for Maruti, so they are seeing more upside from here as well. Nuvama, again, they've cut their target price to 13,800 versus 14,600 earlier, still a 20% upside. They have saying that they're tapering down the expectation for the next 3 years on EPS by 3 to 4%, and they're forecasting about 10 to 11% EBITDA growth overall, but they see that the launch of the e-SUV, which is the electric SUV in next year, will be something to watch out for. The target price also includes a cash component of about 2,000 rupees per share. And finally, Nomura is the other one. They maintained, the neutral, but target price is roughly 12,455 versus 13,100 earlier. And they've said that the higher discounting may continue for the company in the next 2 quarters as well. That's a key negative according to them. And sustainability of margins might be a little difficult. So overall, I think the 14% sales growth, as I first said, it's one of the positives, but brokerages are anticipating the next 2 to 3 quarters might be tough for the company.
Yeah, thanks so much for giving us that perspective, and it's important ahead of the chat that we're going to have with Shahina Mukaddam, who is an independent market expert, and Brijesh Singh, senior technical analyst at Opulent Investment. Thank you so much to the both of you, as always, for joining in, and particularly this week, festive greetings, happy Deepavali to both of you, and indeed to your teams and your family. Shahina, I'll come to you first on Maruti Suzuki. What did you make of the numbers and the commentary? And you were listening to what Puneet was saying. What do you think about what the brokers have also said?
To start with, happy Diwali to you, all the panelists and also your viewers. Actually, I heard Puneet and he's sort of described the results very aptly. The issue over here is, yes, while 14% growth is there currently because of the festive season, for the overall year, the management has guided a 4% domestic sale growth. Exports remain stable, good. At the same time, what I believe is that the EBITDA margin dip that we saw is likely to continue on to the rest of the year also, because it was largely on higher raw material costs. Also, they are seeing some bit of softness in the entry-level vehicles. So all put together, what I believe is that it is better to buy Maruti if you would like to in your portfolio on dips, not at current levels. I would prefer at dips, because I see while the price may not go down too much, the appreciation in my view is going to be capped for the next couple of quarters. One is because of course, slower growth. Two is because value valuations, if you compare it in the overall four-wheeler space, yes, of course, it is cheaper than Hyundai, but at the same time, it is much more expensive than Tata Motors. So, in my view, I believe if one is to look at adding on to this overall space, which I think is going to, show some bit of consolidation over the full year, it would be better to pick up a Tata Motors over a Maruti for the medium term.